Hi folks, welcome to the last video in our review for question 5. And this question again, just as question 4 did, is looking at a full consolidation type question. I thought it was a good idea for you to see a couple of them just to make sure you got the hang of it. In this case, however, Foxx, the parent company, owns 75% of the outstanding, that should be common or voting shares, of course, of Rabb. And just going to put here common or voting shares, same thing. Okay, on January 1, year 3, and in order to get those 75% of those common shares, they paid $117,000. At that date, Rabb, the sub company, they had $50,000 in common shares and retained earnings of $30,000. All the fair values were equal to carrying values. That's Foxx's estimation of Rabb's assets, right, and liabilities, with the exception of inventory, equipment, and software. And what you can see is that according to Foxx thought the fair value of the inventory was less, so that's a fair value decrement. They also thought the equipment was worth more than what Rabb had it booked at. So it's a $24,000 increment. And again, Rabb was carrying software at zero. They didn't think it was worth anything. You remember from your earlier studies, things like software were considered to be intangible assets, right? But in this case, they thought it wasn't worth anything. However, Foxx thought it was worth $15,000. So there's a fair value increment of $15,000. They also told you here in the next paragraph that the equipment had a remaining useful life of 6 years. So that increment on the equipment has to be amortized over 6 years. That's at the date they became acquired. And the software was going to be amortized over 10 years. So you would be amortizing this $15,000 increment over 10 years. Now, they also told you that there was an impairment test done at the end of year 6, and they had recoverable amounts for the software, so it was tested for impairment, as well as the goodwill. So we know we're going to have some goodwill here. The recoverable amount at the end of the year, at the end of the current year, is going to be $20,000. Okay, so we'll have to figure out by working backwards how much was impaired. Now, it says here the impairment losses occurred entirely in year 6. So these two impairment amounts, I shouldn't say these two amounts, but any amounts that lead us to this recoverable amount over and above amortization on the software is going to mean there was an impairment loss. So that impairment loss for software and goodwill is going to be entirely in year 6. So we know that's going to affect our calculation of consolidated net income, right? Amortization expense that you recognize is going to be grouped with admin expenses, and impairment losses are going to be grouped with miscellaneous. Now, at the date, the balance sheet date, December 31st, year 6, they give you the full balance sheets of Foxx and Rabb, and they also give you a statement of retained earnings as well as their income statements. So now what you need to do here, they gave you a little hint here. They told you the notes payable and notes receivable are intercompany. You'll see there's a note receivable here that Rabb's booked, and it says you've got a note payable here, and that's what Foxx has, right? So now what you need to think about is calculating the acquisition differential, goodwill, and NCI. We want you to do an eliminating entry at the acquisition date to eliminate the investment, set up all the increments and goodwill, and set up any NCI. We're going to do all that in the worksheet, right? The consolidation worksheet. Then we're going to do our very important schedule to amortize the acquisition differential and allocate those impairment losses. So if anything we set up here was a little gibberishy, like we're going to make sure the rubber hits the road when we do that schedule and you know where everything is, right? Where it's going and what year it's impacting. Then we're going to calculate consolidated net income using what we did in step C here. And then we'll do our consolidated income statement. We'll also do a consolidated calculation of retained earnings at the end of year 6. We'll calculate the NCI at the end of year 6 for the consolidated balance sheet. We'll actually prepare the consolidated balance sheet. And then, just as we did in a previous question, we're going to change our assumption. So far, we're assuming in this question that Foxx is using the cost method to record its investment. How do we know that? Well, for one thing, we know they paid $117,000 on January 1, year 3, and you see on Foxx's separate entity statements at the end of year 6, that investment is still sitting at $117,000. That means to me that it must have been recorded at cost. All right? So therefore, if they had used the equity method, however, on their separate entity balance sheet, they would not be showing $117,000 for that investment. So the question then becomes, what would they have been showing it at? And that's what we have to calculate when we use the equity method. So why don't we have a look at the solution and we will begin. So now, here we are in our solution doing the first step, which is calculating the acquisition differential, goodwill, and NCI. This is always the first step you'll always do in these questions. So we know from the question that we paid $117,000 as Foxx to get our 75% ownership in Rabb. The implied value of 100%, so what would we have paid for, or what would we have paid if we wanted 100%, if we bought 100% of the outstanding voting shares? We would have paid $156,000. What did we get for what we paid? We got $80,000 worth of book value at the date we became related, which is the common shares and retained earnings of Rabb, meaning that we got value of $80,000. Had we paid, because don't forget, we subtract that $80,000 from this number, 156. Why? Because even though we've only paid for 75% of the shares, we control 100% of the net assets. So this is what we would have paid to control 100% of the net assets, and that's the value of the net assets. So the acquisition differential is $76,000. So how do we allocate it? We're going to allocate a decrement to inventory of $11,000, an increment to both equipment and software. And again, if you go back to the question, they actually told us how to allocate it, right? We could see we had a decrement there in the inventory of $11,000, an increment of $24,000 on the equipment, and an increment of $15,000 on the software, right? So now, of that $76,000, we allocated $28,000. Whatever we couldn't allocate goes to goodwill, which is $48,000. Don't forget, we've always said, unless you're told otherwise, you're using the entity theory. So in our case, under the entity theory, NCI would get its share of the implied value of 100%, and that would be $39,000. So now at acquisition, what do we need to do? On the consolidation worksheet, not on any separate entities books, but on the consolidated books via the worksheet, what do we need to do? We need to eliminate the common shares and retained earnings of the subsidiary company, Rabb. How come? Because don't forget, Foxx is doing the consolidation. Their investors don't want to see the common shares and retained earnings of Rabb because the shareholders of Foxx are not shareholders in Rabb. They're shareholders in Foxx. So we eliminate them, not literally, just figuratively to do the consolidation, right? We set up our goodwill, which we calculated. We set up our NCI, which we just calculated as well, over here. We set up our increment in the software and the equipment, as well as our decrement on the inventory. And by the way, when we set up all of our, eliminate the carrying value, set up all the fair value increments and decrements, and book the goodwill, what do we have? We have what remains is our investment in Rabb. That goes away, right? So we've allocated everything out and eliminated the investment. So what's the next step? In order for us to do anything income related, we got to figure out how much are we amortizing each year, and are there any impairments? So don't forget, in this case, what I did is I separated out any amortizations in year 6 from impairment losses in year 6. And the reason I did it is because you remember in the question, they said any amortizations in year 6 and impairments in year 6 were going to 2 separate accounts. So this helps you to get your account balances right. So that's why I separate them. You don't have to, but that's why I do it. So now I know that at January year 3, we had the decrement in inventory, the increment for equipment, goodwill, and we had goodwill created and software increment, $76,000. That's here. How did I allocate that acquisition differential? Well, don't forget, that decrement in the inventory was fully allocated in year 3. So from years 3 to 5, it got allocated. It got allocated in year 3. Now, the $24,000 increment in the equipment was being amortized over how many years? They told us in the question, if you go back, it was being amortized over 6 years, right? Right here, 6 years. So we had a $24,000 increment on the equipment. Divided by 6, that's going to give us $4,000 a year. So if we go back to the solution, $4,000 in year 3, $4,000 in year 4, and $4,000 in year 5 is going to give us $12,000 over that 3-year period. $4,000 would be in year 6. It does not say that there was any impairment on the equipment, so there's nothing there. So I have left a recoverable amount of $8,000, right? And if you remember in the question, they told us that our software also had a recoverable amount of $8,000. That's purely coincidental. So we know that the software has a recoverable amount at the end of year 6 of $8,000, but how do we get that? Well, don't forget the software is being amortized over how many years? 10 years. So over 10 years, that's $1,500 a year. So we'd have $1,500 in year 3, in year 4, and in year 5. 1,500 times 3 is 4,500. So in year 6, another 1,500 would be amortized, right? But if we add up our 4,500 and our 1,500, that's 6,000. Subtracting it from 15,000 doesn't give us a recoverable amount of 8,000. It would give us 9,000. So that means working backwards, we must have had an impairment loss of 1,000. So again, how do we know that? Well, don't forget, we started off with 15,000 in the software. That was the increment. How much did we amortize? We amortized 4,500. It all totaled across years 3, 4, and 5, 1,500 a year for year 3, 1,500 for year 4, and 1,500 for year 5. In year 6, another 1,500. Well, how am I going to get to 8,000 recoverable? When they do this math, it's going to give me 9,000. That means I must have had an impairment loss of 1,000. So I plugged that guy. I plugged it. So I'll just do a little color coding for you here. That's blue, right? And that's blue. See if we can make it blue. There. So that's how we get it. We have to plug sometimes, work backwards, eh? So that's that. So now, how do I calculate consolidated net income using all this juicy data? First of all, I got to look up here in year 6 to see what happened there. In year 6, and I know I've got amortizations of 5,500 in total for year 6 and impairments of 29,000 in year 6. Those are both going to affect the year 6 income of the sub Rabb. How so? Well, don't forget, first of all, to calculate consolidated net income, I'm going to take the separate entity net income of Foxx. It has to be the income from its own operations. So the first question you got to ask yourself, is there any dividend that Rabb received from its subsidiary company Foxx? Or sorry, is there any, I said that backwards. Is there any dividend that Foxx received from its subsidiary company Rabb? The answer is yes. How do we know? Let's go back to the question. You can see in the question here that in the retained earnings statement, Rabb declared dividends of $20,000. Well, don't forget, if Foxx is a 75% interest shareholder, they're getting 75% or 3/4 of that. So that's $15,000. So $15,000 of that $120,000 is intercompany dividend. So it comes out. So we're looking at adjusted income of the parent company, Foxx, of 105. Now don't forget, we're not literally removing 15,000 from the separate entity statements of Foxx. All we're doing is doing this calculation so we can calculate consolidated balances, right? It's different. It's the third set of books we're interested in getting balances for. So we're making adjustments all the way, but we're not diddling around and changing anybody's separate entity statements. That's critical that you know that. So how much are we going to adjust the 105 by? Well, we got to look at the income of Rabb, which is $48,000. The acquisition differential that we're amortizing in the impairment losses in total, we know are $5,500 plus $29,000, that's $34,500. So that's going to give us, okay, adjusted income of Rabb of $13,500. So our consolidated income is $105 plus what we're adding of the adjusted income of the sub Rabb, and that's going to give us in total $118,500. But we have to show the attribution. Well, the shareholders of Foxx, of this $118,500, they're getting their full 100% share because they are fully invested in Foxx, right? They're getting 100% of their share of Foxx's adjusted income, adjusted for dividend, plus they're getting 75% of the adjusted income of Rabb, 75% of $13,500. Because don't forget, they now own, or through, because Foxx, because of Foxx investment, right? The shareholders of Foxx are also entitled to 75% of the equity in the sub for the year. And that sub, Rabb, earned equity, which is its net income, adjusted, of $13,500. Well, they, shareholders of Foxx, are entitled to their share of that, which is 75%. So in total, we have $115,125 of that $118,500 going to Foxx's shareholders, and then the balance of that $13,500 goes to the NCI shareholders at their share, their pro rata share, which is 25%. So that'll give us $33,750. Now, to do the consolidated income statement, this helps us because this gives us a check figure, right? We know that our consolidated net income should come to, in the consolidated income statement, $118,500. So let's see if it does. Well, first of all, we're going to add the sales of Rabb to the sales of Foxx and get consolidated sales of $1,141,000. We're going to have investment income, because don't forget, in the question, if you look at it, there was investment income here. $15,000 is the investment income that Foxx got from Rabb. That's the dividend. And there's $3,600 that Rabb had on its own. So what we need to do is, we know that $15,000 that Foxx is booking as solely intercompany dividend from its affiliated company. So that would need to be eliminated using the direct method. And then we're going to add in Rabb's. So consolidated, we're only going to get $3,600. So our total revenue items would be $1,144,600, right? Cost of goods sold, we're going to take the cost of goods sold of each entity and add them together to get $680,000. Your admin expenses, don't forget, we said that any amortization expense is going to be booked to admin. So we had to add in that $5,500 for the amortization of the acquisition differential in year 6. There it is right there, right? So that's going to give us $57,500. We know that impairment losses for year 6 were going to miscellaneous expenses. So if we go back to Part C, we can again see that's $29,000. So that's going to be booked here, in addition to Rabb's miscellaneous expenses, which for consolidation purposes are getting added to Foxx's. So we're going to have their miscellaneous expense of $176,600. Income taxes, which are just the separate entity taxes added together, and that's going to give you total expenses of $1,022,100. When we deduct those expenses of $1,022,100 from our consolidated revenue balance of $1,144,600, we are going to get $118,500. The attribution was done in the previous part, so all you need to do is just write it down again. So that concludes the preparation of the consolidated income statement. Now what we're going to do is we're going to do a second video to show you how to calculate the two critical amounts for the consolidated balance sheet, which are consolidated retained earnings and net non-controlling interest. We're going to prepare the consolidated balance sheet, and then we will look into calculating the value of the investment account in Rabb on the separate entity balance sheet of Foxx, if Foxx had used the equity method to record and report its investment.